ever since the financial crisis, we have seen huge swings and changes in the way in which people do their investments. Are you able to share with us, are you seeing that trend, and what are some of the observations?
It's all right. I think the global financial crisis has many consequences, of course, both direct and indirectly. But as far as investing is concerned, what it has done is to remind businesses and investors of a number of actually time-tested truths, which in the boom days of the 1990s, in what Mr. Greenspan used to call irrational exuberance, may have been forgotten. But these truths are always with us, particularly when you run a business or when you invest money. And the first truth, hard truth, let's say, is that investing is risky. It's not easy to make money. There are many problems. You're more likely to lose money than to make money. And we have seen that in the problems which we face today. Europe is facing a major crisis with the Eurozone. Every day we read in the press about Greece, Ireland, Portugal. Now they're worried about Spain, maybe even Italy has seen its borrowing cost rise. How this will be contained, how this will be solved within the Eurozone. Some people have even speculated that the crisis could be so severe that the Eurozone may break up. But the leaders in Europe, Mrs. Merkel in Germany, President Sarkozy in France, have re-emphasized that they are committed to the Eurozone. They see no way except to continue. How to resolve this transfer of money from the wealthier, better growing countries like Germany in the northern part of Europe to the more indebted countries in the south. I think this will be a challenge. And of course, in the US, by early next month, they would have reached a debt limit of $14.3 trillion. There's a big wrangle between President Obama and the Republican majority about how to resolve it. There was even a report that there was an acrimonious meeting yesterday and President Obama walked out of the room. If the debt limit is not raised, the US cannot borrow any more money. And this means this will have tremendous consequences. US will have to decide. They won't have enough money to meet all their obligations. Do they pay bondholders? Do they pay Social Security? Do they pay the military? The rating agencies have said that if that happens, they will even consider re-rating the US credit rating from AAA, and I think this will have tremendous consequences throughout the world. So that's the first hard truth. And even in Singapore here, as you have seen, you know, the impact of all these changes rebound on us very swiftly. First quarter, we had strong growth. Second quarter, almost flat. And if you quarter-to-quarter growth is negative. So things can change very fast. Next 3 months, we'll have to wait and see. The second hard truth, which I said in Davos, which people now realizing is that, you know, in professional investment management, for many, many years, people have felt that, you know, this theme of diversification, you spread out your assets across countries, you spread out your assets among different asset classes, property, private equity, bonds, equities, and then whatever happens in one asset class, you are protected because the other asset class may grow. Now they found when the crisis is severe enough, as in 2 year, 2 on high, this doesn't help. All the asset classes fell. It doesn't matter whether you invested in property or real estate or bonds, everything fell. It's something as investors have never seen before, but it shows the limits of what you might call investment theory, that this is unprecedented. The third hard truth, which many companies and investment firms realize, is a need for liquidity. You may have a sound portfolio, but you may need money. So some of the US university endowments found that even their portfolio is fairly sound, they were not able to realize cash when they want to. This means that you may have to sell at the wrong time. You may have to sell assets which you want to keep. So the need for liquidity is very strong. And of course, the fourth consequences arising out of this is that governments and banks, central banks, and never will they allow this to happen again. So they have required, they are putting in place reforms in the finance system, which basically means they require banks to have more capital and liquidity buffers. The consequence of that, of course, this is from the regulator side, but the consequence in the real economy is that this will mean that there will be less capital for long-term, riskier investments. So overall, I think that investors will be very careful going forward. And it's likely that they'll become risk-averse. They'll become more attuned to short-term fluctuations. Unfortunately also, because of this concentration on short-term issues, instead of stabilizing the economic or investment climate, investors could become more pro-cyclical. When they see a cloud, everybody sells. When they see sunshine, everybody buys. So there'll be more volatility, markets will go up and down more often, and this will create headaches for everybody, including businesses and countries. So overall, a much more difficult investment climate. Go ahead, more problems, more issues. Governments will have to deal with this. Companies will have to deal with this. Investment organizations will have to deal with this. And I think that we all have to be on our toes.